Welcome to TalkTickers. We're here to give you the essential takeaways from today's earnings calls, really boiling it down so you understand what counts.
That's right.
Today, we're jumping into the Magna International first quarter 2025 earnings call.
Yep, I know.
Our goal here is to pull out the key financials, the strategic moves, and, what they're signaling for the future stuff that matters if you're keeping tabs on this space.
Okay, so kicking off with the results snapshot. Magna's Q1 actually came in stronger than their own internal plans.
Oh, interesting. Why was that?
Mostly down to pretty good incremental margins on sales that were higher than they maybe penciled in for the quarter itself.
Yeah.
They also push $187 million back to shareholders. That's dividends and buybacks combined in Q1.
All right, shareholder returns continuing.
Exactly. Now, looking forward, their updated outlook sees higher sales, but that's largely because of foreign currency translation, like the exchange rates moving in their favor.
So not purely organic growth driving that forecast lift?
Not entirely, no. And on the flip side, they are anticipating slightly lower vehicle production over in North America.
Right.
And the combination of those things, particularly the stronger euro and the sort of decremental margins from that lower North American volume, means they're expecting, let's say, modest reduction in their overall profit margin outlook.
Got it. So a better than planned Q1, but maybe some clouds gathering with that revised outlook, especially in the margin front. Let's dig into the actual Q1 numbers a bit more.
Sure. So consolidated sales for the quarter, $10.1 billion. That's actually down 8% compared to Q1 last year.
Okay, 8% down. How does that compare to the overall market?
Well, global light vehicle production was only down about 3%. So
Yeah.
Magna sales fell a bit more than the market overall.
Okay. And organic sales?
Organic sales, stripping out things like currency, were down 6% year over year.
So what was dragging that down specifically?
It was a mix of things. They mentioned a negative production mix in North America, basically. The cars being built had less of their stuff in them on average.
Right, content per vehicle.
Exactly. Plus just lower light vehicle production overall, and also a drop in their complete vehicle assembly volumes. They finished up production for the Jaguar E-Pace and I-Pace, for instance.
End of life for those programs.
Yep. Now, offsetting that somewhat were new program launches kicking in and some commercial recoveries they managed to get.
Okay, so a few headwinds there, partially balanced out. How did all that flow through to the bottom line, the profitability?
So adjusted EBIT landed at $354 million. That gives a margin of 3.5%.
3.5%. How does that compare?
It's down 80 basis points from Q1 2024.
Okay.
And that drop reflects, well, some positive operational items they had, but those were kind of swamped by lower equity income, some tariff costs they haven't recovered yet, and just the plain impact of selling less stuff, lower volumes.
Makes sense. And earnings per share?
Adjusted EPS followed suit, came in at 78 cents. That's a 28% decrease year over year.
Ouch. Okay. You mentioned free cash flow looked a bit better than expected, though.
Yeah, that was maybe a slight positive note. They used $313 million in free cash flow in the quarter, but apparently that was less outflow than they'd anticipated.
Okay, better than feared, perhaps?
Maybe. And they kept up the shareholder returns we mentioned, $136 million in dividends paid, $51 million used for share repurchases in Q1.
And their balance sheet health. Liquidity.
Still looks pretty solid.
Yeah.
Liquidity just under $4.6 billion, and that includes $1.1 billion in cash sitting there. Their adjusted debt to adjusted EBITDA ratio was 1.92. Again, better than they thought it would be.
Okay. Let's switch gears to tariffs. That seems to be a big cloud hanging over a lot of companies. What's Magna saying?
Yeah, definitely a hot topic. They acknowledge there's a high degree of uncertainty around tariffs in the whole trade environment.
No kidding.
Just for context, their North American business was around $20 billion in sales last year, so less than half their global total.
Right.
Now, of the goods they brought into North America in 2024, about $2 billion worth were hit with tariffs.
Wow. Okay. And the cost?
That resulted in roughly $500 million in gross tariff costs. Big number.
Huge. But they mentioned USMCA compliance, right? The trade deal between the U.S., Mexico, and Canada. How does that play in?
Right. That's key. They estimate that about 75% to 80% of the parts they move across North American borders already meet the USMCA rules.
Okay, so a good chunk is already compliant, potentially avoiding some tariffs.
Potentially, yeah. So looking ahead to 2025, their current estimate for the direct annualized tariff hit is around $250 million.
Still significant, but less than that gross number from last year. What are they doing about it?
They've got a multi-pronged approach, working to get even more parts USMCA compliant, obviously.
Makes sense.
Looking into government remission programs, pushing hard on general cost reductions, and being really disciplined with their capital spending.
And what about passing costs on?
Yes. They stated their intention pretty clearly. They aim to recover 100% of any unmitigated incremental direct tariff costs from their customers.
Okay, so pushing it back to the automakers, that'll be an interesting negotiation to watch.
You bet. One important caveat, though. Their updated outlook doesn't factor in any potential ripple effects of tariffs.
Like what?
Like, tariffs making cars more expensive overall, hitting affordability, maybe dampening consumer demand, or even causing automakers to change production plans. None of that broader impact is baked into their forecast right now.
Got it. So that's still a major unknown out there.
Absolutely.
Okay, let's talk production forecasts. You mentioned North America was revised down.
Yeah, they trimmed the North American production forecast by about 100,000 units.
Okay.
The new number is 15 million vehicles for the year.
But Europe is unchanged.
Europe production assumption stays the same. But China, interestingly, they bumped up their assumption.
Oh, based on Q1.
Seems like it, yeah. Based on the outperformance in Q1, they've raised the China production assumption to 30.2 million units.
And they're assuming different currency rates too, you said.
Yep, assuming a higher euro and a higher Canadian dollar against the US dollar for the rest of 2025 compared to their previous estimates.
Those currency swings must make a difference. Do they give any rules of thumb for how that hits the numbers?
They did, actually. Helpful for modeling. They said a 1 cent change in the euro USD rate impacts annual sales by about $110 million.
Okay.
But importantly, that revenue comes in at a below average margin.
Right.
For the Canadian dollar versus the US dollar, a 1 cent change is about $50 million in annual sales. And that revenue comes in roughly at their average margin.
That's useful context. Anything else on modeling drivers?
Yeah, they mentioned their average content per vehicle in North America is currently around $1,300.
Okay.
And under, let's say, normal conditions, their incremental or decremental margin in North America, meaning a profit they make or lose on extra or fewer units, is typically in the 15% to 20% range.
Good numbers to keep in mind. All right, beyond the financials and forecasts, what about strategy? Any cool new projects or business wins they highlighted?
Yeah, definitely some interesting stuff there. They talked up their collaboration with NVIDIA.
Ah, the chip giant.
Right. Working on next-gen active safety and autonomous driving systems. That's obviously a huge growth area.
For sure.
They also announced they won a new contract for a complete ADAS system that's advanced driver assistance with a big North American-based global OEM.
Nice win.
And they're supplying a 2-speed dual-motor e-drive from Mercedes-Benz. So more EV content.
Good to see traction in EVs. Any other accolades?
Yep. They picked up GM's Supplier of the Year and Overdrive Awards. And their AI-based thermal sensing tech got recognized by Automotive News. So some positive momentum on the innovation front.
Okay. What about specific business lines? You mentioned seating earlier. Any updates there?
Yeah, they clarified that one-time $30 million warranty hit in Q1. Said operationally, that's behind them now.
Good.
And generally, the macro factors for seating are holding steady, and their execution plans are on track. They did add the usual line about continuously evaluating all product lines, seating included.
Standard procedure, I guess. Let's circle back to USMCA compliance. That seems really central to their tariff strategy.
It really does. They seem pretty confident that parts meeting the USMCA rules will stay untariffed, even after the initial review period. That gives them more certainty for planning.
And they're trying to boost that 75-80% number.
Definitely. Actively working to increase that compliance percentage. They also touched on talks with OEMs about increasing U.S. content specifically, not just USMCA compliance.
Ah, so sourcing more from the U.S. itself.
Potentially. But they kind of poured cold water on expectations of immediate major shifts. It's complicated, involves big capital decisions, and the scale is massive.
You're right,
Well,
not something you change overnight. What about China? You said they raised the production outlook there. How big is their business?
it's significant, about $5.5 billion in revenue coming from China.
Okay. And who are they selling to, mostly?
Interestingly, over 65% of that China business is with the domestic Chinese OEMs.
Really? Not the global players operating there.
Predominantly Chinese brands, yeah.
Yeah.
Mostly concentrated with 5 or 6 major customers. And remember that 15% revenue growth last year, that blew away the overall China market growth of around 5%. So they're gaining share there.
Impressive growth with local players. Okay, quick updates on a few other things. Share buybacks. Still happening.
Pause for now. They cited the market uncertainty, especially around tariffs and the economy.
Makes sense to conserve cash, maybe?
Potentially. But they did leave the door open to resuming buybacks later in the year if things become clear.
Okay. And those advanced tech programs, the NVIDIA stuff, ideas, any delays or changes in launch plans?
They said no major changes to the overall planning or launch timing. But they are thinking carefully about the manufacturing footprint and the exact timing, the cadence of sourcing decisions for these new programs.
So maybe some deliberation on where and exactly when things get sourced and built.
Seems like it, yeah.
You mentioned the complete vehicle segment outperformed a bit in Q1. What drove that?
Part of it was commercial recoveries tied to volume changes, things built into their contracts.
Okay.
They also mentioned they've been doing some restructuring there to get the costs aligned with the current lower volumes, especially with those Jaguar programs ending.
So right-sizing the operation.
Exactly. And they pointed out some contracts have fixed recovery elements, giving them a bit of a buffer even if volumes dip.
Gotcha. Looking medium term, what's their feeling on EBIT margins? Are improvements still expected?
Yes, they reiterated their expectation to get about 35 basis points of EBIT margin tailwind improvement in both 2025 and 2026.
From what?
Mostly from continuous improvement activities, operational efficiencies, that sort of thing.
Okay, so internal efforts driving that. Any final points? Inventory, Mexico-Canada exposure.
Yeah, quickly on inventory, they saw a spike in North America early in the year, Jan-Feb, but said levels are back down to where they were in December. And their production outlook is based on what the automakers tell them, not their own inventory guesses.
Yeah.
And yes, they detailed their exposure about $4 billion in sales in Canada, with 70% of that sold into the U.S., and $5.5 billion in sales in Mexico, with about 25% sold into the U.S.
Significant cross-border flows.
Huge. And lots of uncertainty about long-term tariffs on finished vehicles coming from Canada and Mexico into the U.S. They also mentioned reshoring talk is happening, but more the tier 2, 3, 4 supplier level, and it needs OEM buy-in because of the business case.
Complex supply chains. Okay, that covers a ton of ground from the call. Really helpful detail.
Glad to break it down.
All right, now for that part of the show where we throw out some slightly unconventional ideas, our This Is Not Financial Advice segment. Based on all this Magna talk, what's an outrageous but plausible trade idea bubbling up?
Okay, here's one possibility playing on a few themes. Magna's pretty well positioned, right?
Mm-hmm.
Supplying traditional cars, supplying EVs. Now, you layer on this tariff uncertainty, which could make imported vehicles, especially maybe luxury ones, more expensive in North America.
Okay, follow you so far.
So the idea could be, go long Magna. They might benefit if there's a shift towards North American production or content. Pair that, perhaps, with a short position in a European luxury OEM that imports a lot into North America.
Ah, so betting on a relative value shift. If tariffs hit imports, the luxury importer suffers, while Magna, being a key North American supplier, might benefit or at least be less impacted.
Exactly. It's a play on how trade policy could shuffle the deck within the auto sector. Whether tariffs happen or not, the uncertainty itself could drive this kind of relative performance. It's definitely speculative, though. Outrageous but plausible, as we say. Got another one.
Sure, here's a slightly different angle. We talked about Magna's strong growth in China, especially with Chinese OEMs.
Right, that 15% growth.
So considering those ongoing global trade tensions, maybe another idea is long Magna again, but this time hedge it with a short position in a major North American OEM that's known to be heavily reliant on imported components from regions facing potential tariffs. So this one bets more on Magna's global footprint and their specific strength in China, maybe being less directly hit by certain U.S.-centric tariffs, while a North American OEM might struggle more with component costs.
Kind of, yeah. It's betting on Magna's ability to navigate this messy global supply chain and capitalize on growth in China, potentially offsetting risks elsewhere, perhaps better than some others. Again, lots of moving parts. Could be volatile.
Definitely volatile. Two really interesting, complex ideas there. It gives you a lot to think about, tying different pieces together.
That's the idea.
Okay, that wraps up our deep dive into the Magna International Q1 2025 earnings call. We've unpacked the results, navigated the murky waters of tariffs, and explored some potential future paths.
A lot to digest.
For sure. Remember, this is all to help you understand the moving parts and inform your own thinking. This isn't investment advice. What really stood out to you from all this? What questions are still lingering? We definitely encourage you to dig deeper and form your own views.
Absolutely.
Join us next time on TalkTickers, where we'll tackle another key earnings call.